Welcome to Module 3, Lesson 2. In this lesson, we'll take a closer look at the Commitment of Traders report, or COT for short, and our COT indicator. Before we dive in, let's take a moment to understand why this report exists, who provides it, and what information is actually inside. The Commitment of Traders COT report is an essential tool for understanding market dynamics. Let's start with the basics. The futures trading market is regulated by the Commodity Futures Trading Commission, or CFTC, a US government agency responsible for ensuring transparency and fairness in the market. Every week, the CFTC publishes the COT report, giving traders a detailed snapshot of market positioning. The report is released every Friday at 3:30 p.m. Eastern Time, but it contains data only up to the previous Tuesday, so there is always a slight lag. Now, you might be wondering, does this lag make the data less useful? The answer is no. Here's why. Institutional investors and other large market participants typically don't make drastic changes to their positions within a single week. These participants often take a long-term strategic approach, meaning their positioning shifts gradually over time. Because of this, the COT report still provides a reliable and actionable snapshot of market sentiment and positioning. It's not about capturing short-term fluctuations. It's about understanding the broader trends and behaviors driving the markets. By analyzing the COT report, we gain valuable insights into the market activity and the behavior of key market participants, helping us better understand the forces shaping the market. Now, let's dive deeper into the Commitment of Traders COT report and look at the three key groups of market participants it tracks. Each group has distinct goals and strategies for participating in the future market. First, commercial participants, users, and producers. Commercial participants are businesses that use or produce the underlying commodity or asset. They mainly use futures as a hedging tool to protect themselves against price fluctuations. For example, a wheat producer might sell futures contracts to lock in a price for their harvest, ensuring they're protected if prices fall. On the other hand, a bread manufacturer might buy futures contracts to secure a stable cost for raw materials, protecting against price increases. Commercial participants are not looking to speculate or profit from price movements. They are focused on managing risk and stabilizing operations. Second, non-commercial participants, funds and money managers. Non-commercial participants include hedge funds, investment managers, and other financial institutions. Unlike commercial participants, their primary goal is to speculate and profit from price movements. These participants analyze market trends, positioning themselves based on where they believe prices will go. For example, a hedge fund might buy futures contracts if they anticipate a bullish trend or sell contracts if they expect prices to drop. Non-commercial participants often have a significant influence on the market due to the size of their positions, and their activity is closely watched by traders seeking to follow the smart money. Third, retail participants, non-reportables. Retail participants are individual traders and small investors whose positions are too small to be reported individually to the CFTC. This group often lacks the resources or expertise of commercial and non-commercial participants. Retail traders mainly participate in the market for speculation, aiming to profit from price fluctuations. However, unlike funds or institutions, retail participants are more prone to emotional decision-making and short-term trading, making their behavior less consistent and often more reactive. Summary. Each group participates in the market for different reasons. Commercials aim to hedge risk and stabilize their businesses. Non-commercials aim to profit from market movements through speculation. Retailers aim to speculate but often lack the strategic depth of institutional players. By understanding the motivations and behavior of each group, we gain valuable insights into the forces driving the market, helping us make more informed trading decisions. In the previous slide, we discussed the three main market participant groups: commercials, non-commercials, and non-reportables. Now, let's look at this snapshot from an actual CT report to see how this data is presented and what we can learn from it. What are we looking at? This example shows the crude oil section of the COT report dated November 5th, 2024. The main data points displayed include position size by group, showing how many long and short contracts are held by commercials, non-commercials, and non-reportables. Changes from the previous report highlight how positions have increased or decreased for each group. Total position size, providing context for how much influence each group has in the market. Key sections of the report. Non-commercials, orange. This group includes funds and money managers. In this report, they hold approximately 314,000 long contracts and 118,000 short contracts, with a notable weekly change adding about 29,000 longs while reducing 15,000 shorts. This shift suggests they may be leaning more bullish, but this is only part of the picture. Commercials, blue. These are the producers and users of the commodity, and they hold the largest position in the market, with about 707,000 long contracts and 918,000 short contracts. Their significant size reflects their role as hedgers who need to manage risks associated with production or consumption. This group reduced their long positions by around 33,000 contracts and slightly increased their shorts. While this might indicate adjustments for hedging purposes, interpreting their intent requires more context. Non-reportables, red. These represent retail traders who hold much smaller positions, approximately 66,000 long contracts and 51,000 short contracts. Retail traders typically lack the size and expertise to meaningfully influence the market, and their positions are often reactive and short-term. However, tracking their activity can still provide useful insights. Retailers often move in the wrong direction, so doing the opposite of what they are doing can help us align with smarter money flows. Position sizing and market impact. One key takeaway from the report is the difference in position sizes between these groups. Commercials dominate the market due to their large hedging requirements, meaning their actions can significantly influence prices. In contrast, non-reportables, retail traders, hold much smaller positions and lack the power to move the market. While they can't drive meaningful change, their actions can act as a contrarian indicator, helping us better understand potential turning points. This is why it's crucial to focus on commercials who reflect underlying supply and demand conditions and non-commercials who reveal speculative sentiment, while using retailers' positioning as a potential contrarian signal. What can we learn? This snapshot provides valuable details about positioning changes and the size of each group's activity. However, it's difficult to interpret the data just by looking at a single report. For instance, are non-commercials consistently adding to their longs, or is this a one-off adjustment? Are commercials' net short positions increasing over time, or is this their usual hedging pattern? To gain a more meaningful understanding of the market, we need to compare the COT report to previous readings to identify trends, shifts, and patterns, making it simpler. As we can see from this example, just looking at the raw report doesn't help much on its own and requires a lot of work to analyze and interpret. But not to worry, our COT indicator does the majority of the heavy lifting for us. It processes the data and displays it in a simpler, more accessible way so we can easily understand and act on it. In the next slide, we'll take a closer look at how the indicator works and how it simplifies the COT data for better decision making. Let's now take a closer look at the first group of market participants, commercial. Recap. Who are commercial? As we've already learned, commercials are users and producers of the underlying commodity. These include businesses like farmers, oil producers, manufacturers, and industrial users. They represent the supply and demand side of the market and mainly use futures for hedging purposes. Their main goal isn't speculation, but managing price risk to protect their operations. Why are commercials so important? They represent true supply and demand. Commercials are directly involved in the production or consumption of the commodity, so their positions reflect real-world forces of supply and demand. They're interested in the underlying asset. Unlike speculators, commercials have a vested interest in the physical commodity itself. For example, oil producers might sell futures to lock in prices for their production, while industrial users might buy futures to secure costs. They buy into weakness and sell into strength. Commercials behave counterintuitively compared to how most novice traders think, buying into weakness. When prices are falling, commercials, like industrial users, buy future contracts. To someone new to trading, this might seem odd. Why buy when the price is going down? The answer is simple. They see falling prices as an opportunity to lock in lower cost. For example, a bread manufacturer may buy wheat futures during price declines to secure cheap raw material for future production, selling into strength. Conversely, commercials, like producers, often sell future contracts when prices are rising. To a casual observer, this might look like betting against a rally, but the goal is to take advantage of high prices to secure revenue. For instance, a corn farmer might sell futures at high prices to lock in favorable income for their future harvest, ensuring profitability even if prices drop later. Example to clarify. Imagine you're an oil producer. If oil prices are soaring, you might decide to sell futures contracts to lock in those high prices for your upcoming production. This protects you in case prices fall later. On the other hand, if you're a manufacturer who relies on crude oil as a raw material, you might buy futures contracts when oil prices are dropping to lock in low cost for your future operations. This counter-cyclical behavior, buying when prices are weak and selling when they are strong, is driven by commercials' need to hedge against market volatility, not speculate. The biggest and smartest players, commercials, are the largest participant in the market, with the most capital and information at their disposal. They often have access to insights that retail traders and speculators don't, making them highly influential. They're usually right. Because commercials are so closely tied to the underlying fundamentals, they tend to be on the right side of the market at key turning points. When they shift their positioning significantly, it often signals an impending change in trend. Why a rise in net long positions matters. Let's look at the attached chart as an example. Here, we see that as the price of crude oil was decreasing, commercial long positions, blue line, were steadily increasing. Commercials were buying into weakness, accumulating positions as prices dropped. Eventually, this accumulation reached an extreme compared to the previous reading, signaling that commercials believe prices were nearing a bottom. Shortly after, the trend reversed and prices began to rise. This behavior underscores why we want to trade with commercials. Their actions provide us with critical insights into market fundamentals, and aligning our trades with their positioning can give us a significant edge. Let's now shift our focus to the second group of market participants, non-commercials or large money managers. Recap: who are non-commercials? Non-commercials include large money managers, hedge funds, and institutional investors. Unlike commercials, who hedge to manage business risks, non-commercials participate in the market solely to speculate and profit from price movements. They have no interest in owning the underlying commodity and are only concerned with trading the price trends of future contracts. Why are non-commercials important? They participate to speculate. Non-commercials are active speculators in the market. Their positions represent their outlook on price movements, providing valuable insights into market sentiment, whether speculative money is bullish or bearish. They have no interest in owning the underlying asset. Unlike commercials, non-commercials have no business-related need for the physical commodity. Their focus is purely financial. For example, a hedge fund buying crude oil futures has no intention of taking delivery of barrels of oil. They are only interested in profiting from price fluctuations. They employ various strategies. Non-commercials are often associated with trend following, where they add to positions as prices rise or fall, reinforcing the momentum. However, they don't always follow trends. Many non-commercials use contrarian strategies or complex quantitative models depending on market conditions. This diversity makes their behavior an important indicator of speculative activity, but not a perfect predictor. Serve as an early warning system. The most valuable insight from non-commercials comes when their positioning diverges from price action. Divergence occurs when prices continue in one direction, but non-commercials begin shifting their positions the opposite way. These moments often act as early warning signals for potential trend reversals, as large speculators may be adjusting their positions based on deeper market analysis or anticipating shifts in fundamentals. Why look for divergence? Let's analyze the chart. Here, the price of the underlying asset is decreasing, forming lower lows, red arrows. However, if we look at the non-commercials, long positions, yellow line, they're not making lower lows. In fact, their long positions are slowly increasing during this period. This divergence between price action and non-commercials positioning serves as an early warning signal that the downtrend may be losing strength. Shortly afterward, we see the trend reverse, confirming the shift in market sentiment. Key takeaway: while non-commercials often participate in trend following, they don't always stick to one strategy. Watching for divergence between their positioning and price action can provide valuable clues about impending changes in the market. They act as an early warning system, helping us prepare for potential reversals before they happen. Aligning our trades with these signals ensures we're staying ahead of the curve and not caught on the wrong side of major market moves. Let's now focus on the third group of market participants: retailers or non-reportables. Recap: who are retailers? Retailers or non-reportables represent individual small traders and investors whose positions are too small to be reported individually to the Commodities Futures Trading Commission, CFTC. They are the smallest group in the market by both position size and influence. Why are retailers important? They trade smaller volumes. Retailers typically lack the resources to take on large positions in the market. In the CUT report, their positions are aggregated under the non-reportables category. They have the least capital and market intelligence. Retail traders generally don't have the same access to information, tools, or research as large institutional traders or commercials. This often leads to decision-making based on limited knowledge or emotional reactions to price movements. They're usually on the wrong side of the market. Because of their lack of market intelligence and smaller position sizes, retail traders tend to follow trends too late or trade based on fear and greed. This behavior makes them a contrarian indicator. Their extreme positioning often signals potential turning points in the market. When retailers are extremely bullish, prices tend to drop. And when they are extremely bearish, prices tend to rally. An important exception. It's worth noting that not all non-reportables are strictly retail traders. In some cases, small commercials, for example smaller producers or businesses, might fall under the non-reportables category if their positions are below the CFTC reporting threshold. Example markets. In agricultural markets such as corn or soybeans, small family farms might fall under the non-reportables category even though their behavior aligns more with commercial. Likewise, in exotic markets like platinum, small-scale producers or refiners might also fall under this category, as their positions don't meet the threshold to be categorized as commercial. These exceptions can be important to identify, as small commercials in non-reportables category are still motivated by hedging rather than speculation, and their behavior won't align with typical retail traders. Why trade against retailers? Let's analyze the chart. In the first example, left side, retailers are extremely bearish, as shown by the low position level on the red line. While retailers are expecting price to continue dropping, the market does the opposite. Price rallies. In the second example, right side, retailers are extremely bullish, significantly increasing their positions. Once again, the market moves in the opposite direction and prices drop. This pattern occurs because retailers tend to enter trades too late, often following trends that are already nearing exhaustion. Their extreme positioning frequently signals the end of a trend rather than its continuation. Let's quickly summarize what we have just learned about the three key groups of the market participants in the Commitment of Traders report, and how we can use their behavior to guide our trading decisions. Commercial behavior. These are the market makers, users and producers who represent the real supply and demand of the commodity. They mainly hedge to protect their business interests rather than speculate. Action. Because commercials are closely tied to the underlying fundamentals, we want to trade with them, aligning our positions with their movements, especially at extremes in their net positioning. Non-commercials. Behavior. These include fund managers and institutional investors who speculate on market trends. They often follow the price trend and increase positions accordingly. Action. Non-commercials serve as an early warning system, especially when we spot divergence between their positions and price action. Divergence can signal potential trend reversals, giving us valuable foresight. Retailers. Non-reportables. Behavior. These are novices, small traders who often trade small volumes and lack market intelligence. Retailers tend to be reactive, entering trades too late and getting caught on the wrong side of the market. Action. We want to trade against them, as extremely bullish or bearish positions from retailers often act as a contrarian signal for potential reversals. Looking ahead. While understanding the behavior and positioning of each group is essential, analyzing the raw COT report can be overwhelming and time-consuming. That's where our COT indicators come in. They simplify the data, visually highlight the positioning of market participants, and make it much easier to spot actionable signals. In the next slide, we'll introduce these indicators and demonstrate how they help us analyze the market more effectively. Now that we understand the different market participants and how the positioning influences price action, let's take it a step further and introduce the COT indicator, a powerful tool that simplifies the analysis of the raw commitment of traders data. The COT indicator displays the positioning of different reporting groups, commercials, non-commercials, and retailers in relation to one another, allowing us to see how they compare at glance. Puts their positioning into context by showing how it changes relative to the previous weeks, helping us identifying trends and shifts over time. Converts the data into an oscillator, making it easy to spot extreme positions, which often signals key turning points in the market. By combining these features, the COT indicator helps us predict the end of the bend. Those moments when market trends are nearing exhaustion. It provides us with a clear, fact-based bias, ensuring our trades are aligned with the true forces driving the market. In the next slides, we'll dive deeper into how this tool works and how to interpret its signals effectively. Now that we've introduced the COT indicator, let's go over how and where it's best applied. Used for finite markets and Forex major pairs. The COT indicator works best in finite markets, such as commodities, where there is a defined supply. It can also be applied to Forex major pairs, providing valuable insights into the currency markets. Only works on weekly charts. Since the COT data is released only once a week, the indicator is designed for use exclusively on the weekly chart. This makes it a great tool for identifying long-term trends and biases, but not for a day-to-day trading decisions. Data lags. Remember, the data has a slight lag, and because it reflects weekly and reflects positions as of the previous Tuesday. However, this lag doesn't diminish its effectiveness for analyzing trends and extremes in market behavior. Trade with commercials at extremes. When commercials reach extreme positions, either heavily long or short, it often signals a significant shift in the underlying market. These are the moments where trading with commercials gives you an edge by aligning with true fundamentals. Trade against retailers at extremes. Retailers tend to be on the wrong side of the market at extremes, making their positioning a useful contrarian signal. When they're excessively bullish or bearish, consider taking the opposite side. Exception. Keep in mind that some small commercials, for example, small producers or businesses, may fall under the non-reportables category. Their behavior may not align with the typical retail speculation. Not a timing tool. The COT indicator is not a tool for precise timing. Instead, it provides a bias or directional insight. Use technical analysis to refine your entries and exits, ensuring you're trading with optimal risk and reward. What's next? Now that we've covered the theory and application of the COT indicator, it's time to see it in action. In the next slide, we'll dive into real-life charts and demonstrate how the indicator works in practice, how it displays market positioning, highlights extremes, and helps us build a fact-based trading bias. Hi, welcome back to another practical application session. In today's session, I want to talk to you about the COT index. So let's head right into the charts. Right now, I'm on Campus Fund. It's our trading platform. It runs on TradingView, by the way. So right now, I'm looking at gold. And before we start, I just want to remind you again that the COT data is only released once a week, meaning the index or the indicator also updates only once a week. So always make sure that when you look at the COT indicator that you're on a weekly chart, not on a daily chart or a minute chart. The indicator will show you data, however, that data will be completely useless to you. So right now I'm looking at gold and I'm on a weekly chart. So let me load the indicator and then explain a little bit more about how it works and how we like to use it in our daily trading routine. To load the indicator, we go here to indicators and then we look for the COT index by OTC. You click on it once and then just give it a little bit of time to load. All right, you might now feel a little bit overwhelmed because there's a lot of colors here, there's a lot of lines and a lot of numbers. But don't worry, I'm here to talk to you about everything. I'm going to break everything down step by step, go over the settings, explain how the indicator works and how it visualizes the data, and then explain to you how to best use it in your trading routine. So we've established that the COT report essentially publishes on a weekly basis the net position of 3 different reporting groups. So our users and producers, which are right here in blue, our fund managers, which we display here in orange, and our retailers or non-reportables, those guys are here displayed in red. And it shows their positioning as well as their positioning changes relative to previous weeks. So from the positioning, we could establish whether or not they are overly bullish or overly bearish. However, there's a problem. The problem is that we essentially have years over years of historical data available. So if we would just see, okay, when was their all-time high and when was their all-time low in terms of their positioning, so when were they very, very bullish or very, very bearish, it kind of misses the point, because what was extremely bearish years ago might not really be considered extremely bearish or bullish in today's environment. So we need to kind of have a reference point and need to put a stick in the ground on the time frame, on the timeline, where we say, okay, we want to compare until here, but not really beyond that point. So the indicator can help us do that. And that we can do in the settings. So let's double click on the indicator to open up the settings. And here we see two different numbers that you can essentially change. One is the weeks look back, which is right now set to 26 or 26 weeks or 6 months. And the other one is the week look backs for historical highs and lows, which at the moment is set to 156 weeks. In other words, for 3 years. So why does that matter? Let's quickly remember those numbers, 26 and 156, and let's look again at the indicator itself. Now, think about it this way. The indicator plots the net positions. It then determines, because we said 26 week, it then plots a line at the highest point and the lowest point of the positioning in the past 26 weeks. And that would be our 100% and our 0%, essentially. It then adds two more lines, which is right here, the green and the red line, which shows us a bullish or bearish extreme. It does so by saying, by plotting a line that is in an 80-20 range. So between the 100 and 0, it then plants the 80 and 20 line, or the 80 percentile and the 20 percentile. So data points that fall at or below the red line, so below the 20%, are considered very bearish positions within the past 26 weeks. If the data plots at the green line or above, it means that they're very bullish relative to the past 26 weeks. Obviously, if you would change this number in the settings, you would extend or shorten the look back period, and therefore you would have then new highs and lows, and therefore the indicator would also adjust. Now, we have then also here the 100 line in gray and the 0 line here at the bottom. This is, like I said earlier, the highest point and the lowest point in the past 26 weeks in terms of their positioning. So if one of the reporting groups is at or above, or at or below the 0 line, or at or above the 100 line, it means that they are at the highest point in the past 26 weeks or above that in terms of the net positioning. Now, we have one more line, which is the dotted line up here, which is at 120, and the dotted line below here, which is at -20. And this refers to the 156 for the 3-year look-back period. So this is essentially the same thing, just zoomed out a lot to give more historical context. So if we have a reading that is at the line up here or at the line down here, it simply means that our reporting group, whoever touches that line, is in a 3-year bullish or bearish extreme. It doesn't tell us if it's an all-time high or if it's higher than it was 3 years ago. It just says that within the past 3 years, they have been at or below this line, but never higher. And so these are our extreme points. Now, we have the 3 different reporting groups here. And what we essentially want to do in the COT index is to see, are the commercials in an extreme and are the retailers in an extreme. For the fund managers, the guys in orange, we usually look for them to diverge from price because they're trend followers. So while you can do that in the COT index, it's a little bit difficult to spot diversions, and it's a lot easier to do that in the COT net indicator, which we will discuss later on. So for right now, I'm just going to remove them from the indicator or hide them. To do that, you just double click, click here on show non-commercials, and you uncheck it. And now they're no longer part of the index. I want to do a little bit of backtesting now to show you just how powerful the tool is, but also to explain to you what the different reporting groups are doing. So let's start with the commercials. I'm also going to hide the non-reportables or the retailers for now. So we only left with the blue line. I'm also going to hide price, and I'll get price back later on. And I'm just going to now put in vertical lines whenever the commercials were at a bullish extreme. So when they were at or above that green line, like they have been here or here, and then here or here. And here you can see they touched the dotted line. Remember, this is our 156-week line. So here they were in a 3-year extreme. So let's also plot these ones out, 1, 2, and 3. And then we do last one, this one down here. And before I now bring back price, I can make the forecast that with high probability, whenever we are at a blue line, that price subsequently is most likely to rally. Not always, but in the majority of the cases. So let's have a look whether or not that is true. So we're going to bring back price. We start with our first example down here in 2022. And we can see that once the commercials were, from their positioning point of view, relative to previous readings, very, very bullish because they crossed here the green line, price started to rally. Now, in the next case here, where they were in a 3-year extreme, price actually started to decline before it then started to rally. So here is one example where the indicator was too early. And there's a teaching point in here, or actually several teaching points. First one being the COT indicator is not a timing tool. So we don't enter a position just because the indicator shows us an extreme value. This is a tool designed to give us a bias and to tell us whether or not a market with high probability is ripe for a change. It cannot tell us really when that will happen. We need supply and demand for that. So we never use the indicator in isolation. We always combine it with all the other tools that we have available. It also, the second teaching point would be, it shows us that while commercials can be in extreme, they can be even more extreme in their positioning, and they can also stay in an extreme positioning for a prolonged period of time. So what has happened here is while price was falling, commercials were accumulating, they were buying more and more inventory. And they continued to do so, and that's why they kept on being in that 3-year extreme until price eventually started to rally. We can also, and this would be the third and final teaching point for this particular example, see that the higher the historical extreme, also the stronger move that we can expect. Because we were here in this multi-year extreme, we then got this a very strong move out of it compared to what we had previously seen. Then here in these two examples, let's make this a little bigger. Here price started initially to rally a bit before it declined, but then they were again in a multi-week extreme and we got this big rally out of it. Here again, we immediately got a rally out of price, and here also. So to conclude, we can say that more often than not, commercials tend to be on the right side of the trade, and they tend to know when the market will shift into which direction it will shift. So commercials are usually correct. Now, let's have a look at the retailers. What do they do? So I'm going to hide the commercials for now. I'm going to show the retailers or the non-reportables. We're going to do the same exercise. So in this example, let me again hide price. And I'm just going to move now the blue lines to scenarios where the retailers were very, very bearish, where they were in a bearish extreme. So when they were at or below the red line. So for example, this one, we can just leave it. Here, we can have one here. They were very bearish here. And here, this is this multi-year extreme, right? They touched the -20 line. And we do one more, this one. And same like I did with the commercials, I can now do the prediction that with high probability, if I now reveal price after I drew in a blue line, prices, most of the cases, will be dropping afterwards. So again, let's reveal price and see whether or not that is true. So in our first example here, we can see that price actually started to rally. So again, it's not 100% guarantee, but let's look at the other examples. Oh, sorry. Actually, they were very, very bearish. So they were expecting price to decline, but price actually started to rally. So here the indicator was spot on. In the next example, again, price was declining. The retailers were in a multi-year extreme in terms of their bearish positioning. and price started to subsequently rally. The same thing happened here and here. This is actually the only example where they were correct, right? So price actually did drop then before it ultimately continued to rally. And they were again over here in a bearish extreme, and here they were in a bearish extreme, price started to rally. Here they were in a bearish extreme and price started to rally. So same like we did with the commercials, we can say that in most of the cases, the retailers tend to be wrong. So if we now look also at the commercials in the index, it sometimes takes a little bit of time for them to load. So just give it a second and be patient. But we can see, and we will see, that most of the times when the retailers were in a bearish extreme, commercials were on the opposite side of the trade and they were actually in a bullish extreme. So for example, right here, here, and here, or here. And that shows you that we want to trade with the commercials because we have established that most of the times they are correct. And we want to trade against retailers because they are usually incorrect or wrong. So they are almost like a counter indicator. So how do we use then the indicator in our trading routine? Since it's only updated once a week, and the data comes out on a Friday afternoon in the US, so meaning Friday evening in Dubai, I like to look at the charts on a Saturday morning because then I can rest assured that the data has been updated and the newest data is loaded into the indicator. I then go through the markets and I want to find markets where the commercials and the retailers, the blue and the red line, are on opposite ends of the spectrum. So, for example, the retailers being very, very bullish and the commercials are very, very bearish. That would give me a very data-driven bias to one side. If they are looking, if they're showing me the same, or if they're both near the neutral line in the middle, meaning that they don't really have a clear positioning, they're not very overly bullish or overly bearish, then that just shows to me that the market is not yet ripe for a correction. The players haven't really established themselves yet and positioned themselves yet, and then I can just skip that asset and move on to the next one. So I always want to see extreme readings that will then prompt me to investigate further. Like I said earlier, I will never act on the COT index by itself. I will always then conclude further investigations using valuation, seasonality, and supply and demand. But it gives me a quick and effective way to go through all the markets and see whether or not I need to investigate further and find an opportunity for a trade. And with that, I would like to close the session for today. Thank you very much, and I'm looking forward to seeing you in the next one. Now that we've explored the COT indicator, let's take a look at another powerful tool, the COT net indicator. While it uses the same underlying data, it presents it in a different way, offering additional insights into market dynamics. What is the COT net indicator? The COT net indicator provides a cleaner and more focused view of the market by displaying the net positions, that's longs minus shorts, for each participant group individually. How is it different from the COT indicator? Same data, different presentation. Like the COT indicator, the COT net indicator uses the data from the commitment of traders report, but it doesn't wrap the data in an oscillator. Instead, it shows the actual net positions as raw values, giving a more direct representation of what's happening in the market. Focuses on one group at a time. This indicator isolates the positioning of a single participant group, whether it's commercials, non-commercials, or retailers, allowing us to dive deeper into their behavior without the distraction of other groups' data. No oscillator boundaries. Unlike the COT indicator, which confines data within the boundaries of an oscillator, the COT net indicator provides unrestricted data. This makes it easier to spot absolute extremes in positioning as well as incremental changes over time. It is also the ideal tool to spot divergences in non-commercials behavior, where their net positioning starts to shift against price trends. This divergence often acts as an early warning system for potential trend reversals, giving us an important edge in anticipating market shift. Highlights position changes over time. One of the biggest strengths of the COT net indicator is its ability to put recent position changes into context. By comparing net positions from the latest report to the previous weeks, we can identify whether a group is building or reducing positions relative to their historical behavior. Tracks changes within a single group. This makes it an excellent tool for tracking trend development or shifts in sentiment for one specific group, such as commercials increasing their net longs or non-commercials reducing their net shorts. Why use the COT net indicator? The COT net indicator is ideal for traders who want a detailed group-specific view of market positioning. By stripping away unnecessary boundaries and isolating net positions, it provides greater clarity into how a particular group is behaving week to week. With this tool, we can more easily spot patterns, trends, and extremes in a single group's positioning, helping us sharpen our analysis and improve our ability to anticipate market shifts. Now that we've introduced the COT net indicator, let's discuss how to use it effectively in your trading. Key considerations for using the COT net indicator. Use for finite markets and Forex major pairs. Just like the COT indicator, the COT net indicator works best in finite markets, such as commodities, where supply is limited. It can also be applied to Forex major pairs, providing valuable insights into currency dynamics. Only works on weekly charts. The COT net indicator is designed for use on the weekly time frame, as the data is only updated once a week. This makes it most effective for identifying long-term trends and biases rather than short-term trading opportunities. Data lags. Remember, the data reflects market positions as of the previous Tuesday and it's released on Friday. While this lag means that the data isn't real-time, it remains highly effective for analyzing broader trends and extremes in positioning. Look for fund manager divergence. One of the most powerful uses of the COT net indicator is spotting divergence in non-commercials. For example, if prices are trending higher but fund managers begin reducing their net long positions, this divergence could signal that the trend is losing momentum and a reversal may approach. Likewise, if prices are trending lower but fund managers start increasing their net longs, it might indicate that the market is preparing to bottom out. These divergences provide an early warning system and allow you to position yourself ahead of major market shifts. Deep dive into data to identify ATH or ATL positioning. Another key use of the COT net indicator is identifying all-time high ATH or all-time low ATL positioning within a single participant group. For example, if commercials have reached an ATH in net long positions, this could indicate an extreme level of hedging activity, signaling that prices are near a bottom. Conversely, if retailers have hit an ATL in net shorts, it might signal extreme bearishness, often seen at a market turning point. By comparing current positioning to historical data, the COT net indicator helps you to put recent movements into context, enabling better informed trading decisions. Conclusion: the COT net indicator is a versatile tool for identifying market extremes, tracking divergences, and analyzing long-term trends. By focusing on weekly data and comparing current positioning to historical highs and lows, this tool allows you to anticipate major market moves and develop a fact-based trading bias. Let's jump into the charts once again and see the COT net indicator in action and discuss practical examples of how the COT net indicator complements the COT indicator. Welcome back to another practical application session. In today's session, I want to talk to you about the COT net indicators. As always, let's jump into the charts and see the indicators in action. Right now, I'm on Compass Fund, our trading platform. It runs on TradingView, by the way. So we've seen the COT index before, so let's have a look at the net indicator. And we have 3 of those. One for the commercials, one for the fund managers, and one for the retailers. And I want to start by loading the one for the commercials and for the fund managers into the chart. So as always, I go to indicators and I look for the CET commercials net positions and I load that one. And I want to have the CET non-commercials net positions. And I'm also going to load this one. So like before, we have the commercials in blue and the fund managers in orange. And as always, I'm on a weekly chart because remember, the CET index and also the CET net positions, they need a weekly chart to properly function. I'm on the euro right now, and I want to talk to you a little bit about the two market participants here, so our commercials, our fund managers, and how they behave in the markets and how we can use their behavior to anticipate major moves. So remember from the module that each of these groups has a completely different reason as to why they participate in the markets. The commercials, they participate in the market to hedge against price fluctuation, meaning that they don't really want to benefit from prices moving. They want to actually stay away from that. And they want to lock in favorable prices for their business. Then you have the commercials who are actually on the complete other end of the spectrum. They participate in the market because they have zero interest in the underlying. They just want to make money off the fluctuation of price. So we can already establish that the two groups have completely opposite reasons why they participate in the market. And that's why, as we will now find out, they're usually also on the opposite side of the trades. So if you look at the commercials and if we look at price, you might be confused because you would say that the commercials behave counterintuitively towards price, meaning that if price rallies, the commercials become more and more bearish, and if price declines, the commercials become more and more bullish. Again, think about why the commercials participate in the market. They want to hedge risk, meaning if price rallies, so the underlying, the asset that they produce becomes more and more expensive, they want to sell inventory and lock in these favorable higher prices. That's why when prices go up, they become more and more bearish. Now, the fund managers on the other side, they're trend followers. Remember, they want to make money off price speculation. So if price rallies, they obviously become more and more bullish because they want to buy the underlying and hold it and sell it later on for a higher price. And that's why the commercials behave usually counterintuitive to price, and the fund managers, they tend to follow price, they're trend followers. It is important to note that because the data comes from the futures market and the futures market is highly regulated, that these financial institutions, be it commercials or fund managers, they underlie strict risk management parameters, meaning they are not allowed to endlessly buy or sell the underlying or have endless positions. There are clear guidelines for risk management purposes and market manipulation purposes in terms of how many positions they can open or close. And that depends on factors like the inventory that they hold, the financial assets they have under management, and other factors that are not really relevant to us. What is relevant to us is to understand that there is a limitation in terms of how much they can sell and how much they can buy. So if we look at the Euro chart here and we just start to look at extremes, these extremes, by the way, would be hidden in the index due to the oscillator that we put around. So in the net positions, these extremes, they become visible because there are no boundaries to the positioning sizes and the data that is being displayed. So back here, for example, in 2010, we can see that the commercials, from their positioning point of view, were at an all-time bullish positioning. So meaning that never in the history of the euro have they been that bullish. Conversely, the fund managers, the money managers, have never been more bearish. If we now go back to the train of thought where we established that there is a limit in terms of how much ammo they have, meaning how many positions they can open, we also need to acknowledge that at some point they reach the maximum. So meaning the commercials who at this point were were accumulating, so in other words, they were buying, they at one point reach a limit where they cannot really buy anymore. They're not allowed, or they're physically not capable of buying more. At the same time, the commercials were at the same time, the hedge funds, which were following the trend, meaning they were shorting, at at some point of time, they were not able to sell more. So once these two groups were usually on the other spectrum of positioning reach their limit and their capacity, they have to flip, meaning the commercials then have to start becoming more and more bearish. They have to start selling, and the fund managers have to start buying. And whenever they are in these extremes, this is when major shifts in the market occur, like we've seen here in 2010. There's another example a couple of years later, here in 2011, right, where then the commercials were at net bearish, almost at an all-time bearish positioning, and the commercials reached a new recent bullish extreme. And then again, they reached their capacity and the market started to shift. The same thing happened here again in 2012. See, again, we were at all-time highs and lows when it comes to their bullish and bearishness. So the commercials here towards June of 2012 were at an all-time bullish positioning, whereas the commercials were at an all-time bearish positioning. And then we saw the market turned and started this multi-year rally. So is there a way for us to kind of predict these major turning points? And there is, by looking at the fund managers. So remember from the module that we said the fund managers are trend followers, meaning we want to spot divergence. Or in other words, we want to find instances where the positioning does not track price anymore. So for example, price would make a new higher high. However, the positioning, the net position of the fund managers would not be more bullish than previously. It would actually be flat or maybe even a little bit more bearish. Then there would be a discrepancy in terms of where price is heading in terms of the direction and where the positioning of the fund managers is heading. So it is very difficult to spot these, and it's a very advanced strategy, and that's why we have two set of indicators. The index is a much easier to use tool for CET because it puts it in a nice oscillator. We quickly can identify whether or not they're in the bullish or bearish extremes. With the net position, however, you can put these data readings into a broader context and really also establish these big market moves that don't tend to happen so often. But when they do happen, they carry a lot of weight and they carry also a lot of strength. Now, one example of this divergence was, for example, here. And pay close attention to what happened from here to here. Let me just make this a little bit bigger, and let's for now only focus at the fund managers. So we can see that price was in a multi-month bearish downtrend, right? It kept on making lower lows. From the 6th of September to the 26th of September, it again made a lower low. So if I put a trend line in there, you can see that the beginning of the line is higher than the end. So there is a lower low. However, look what the fund managers did. If they would be following the trend, they should have also made a new lower low in terms of they should have become even more bearish, right? The bearishness should have increased. However, they actually started from a net point of view to become more bullish. So you can see if I put a trend line here, the beginning of the trend line would be lower than the end of the trend line. In other words, it's diverging, right? You can see that price went lower, the positioning of the fund managers became actually more bullish. So this was a first indication for us that this downtrend is most likely coming to an end, and we would start to see a rally because after all, they are trend followers, so they're usually in sync with price. At the same time, we also saw that the commercials reached an all-time bullish, not an all-time, but they reached a bullish extreme. So they were compared to their previous readings. So if you look left, they were very, very bullish, giving us another clue that the market was ripe for a correction. So with this, I hope you can now have a better understanding of how to use the net indicator and how to use it to spot these larger movements in price. There's one reporting group that we haven't talked about yet. And this is the retailers. So let me quickly get rid of the commercials and fund managers and look at what happened to the retailers in these extremes that we've previously identified. So I'm going to go ahead and quickly remove fund managers and commercials, and I'm going to put in the retailers. So this is going to be our red line. Now, notice what happened. We already established in the previous practical application that the retailers are usually on the wrong side of the trade, right? They usually get caught up in this battle between the commercials and the fund managers, and they end up losing. So this first blue line was a turning point where the market was in a very, very bearish downtrend, and it then shifted and became very bullish. But look at what the retailers did. They actually continued to be extremely bearish, especially if you put that into context to their previous readings. So they kind of doubled down on the downtrend, hoping that the rally to the race to the bottom would continue. But then ultimately the market just went the other way. The same thing happened here in 2011. So the market was rallying. The retailers here started to double down. They were thinking this rally would continue. They were in a bullish extreme, only to see the market then turn against them and to sell off. And if we go forward in time to our divergence example, this was another telltale sign. So we had commercials in a bullish extreme, we had fund manager divergence, but what did the retailers do? The retailers also created a new lower low, and they became net even more bearish than before. So this again showed us they were in an extreme, that they were in a multi-week, multi-month bearish positioning. So this gave us another clue that the market is ripe for correction, because they usually are on the wrong side of the trade. So with this, I want to conclude this practical application, and I hope that you now have a clear understanding of how to use the COT index, but also of how to use the COT net positions. Thank you and goodbye. Summary: the power of COT data. Let's wrap up everything we've learned about the commitment of traders' data and how it supports our trading decisions. A glimpse into market participants' positioning. The COT data gives us unique insights into the positioning of all market participants: commercials, non-commercials, and retailers. This helps us understand who is driving the market and how their positions are evolving, as real-time as it gets. While the data has a slight lag, it's as close to real-time as we can get when it comes to understanding the underlying forces in the market. It provides a snapshot of positioning that is highly actionable for long-term trends. We use COT to establish a bias. The COT data is a bias tool, helping us determine whether a market is fundamentally bullish, bearish, or neutral. It is especially effective in finite markets like commodities and major currency pairs, where understanding the positions of commercials and fund managers is critical, not a timing tool. While the COT data shows when a market is fundamentally ripe for a change, it doesn't tell us when or where the change will occur. This is why we combine COT data with seasonality and technical analysis to refine our entries and exits, ensuring we trade at optimal points, predicting major turning points. One of the most powerful aspects of COT data is its ability to help us predict major turning points before they happen. By spotting extremes in positioning and divergences, we can anticipate shifts in market trends with confidence. Works on weekly charts. Finally, remember that the COT data is best suited for use on the weekly chart, aligning with its weekly reschedule and its focus on long-term market trends. One last thing before we wrap up this lesson. Every week, we host live practical application classes focused on our proprietary indicators. These sessions are a great way to watch our mentors apply the concepts from this module directly on the charts. It is also the perfect opportunity to ask questions and get real-time feedback. Head over to the calendar section on the website to check the schedule and join the next session. I look forward to seeing you there and in the next lesson.